So we've seen costs, total costs in particular, and we've also had a look at total revenue. So once we've done that, we can start to think about total economic profit. Total economic profit is simply total revenue generated by the sale of a quantity of products produced minus the total cost of producing that quantity of products. But for our firms, we're assuming that they're not just aiming to make profit, rather they're aiming to make the largest profit they can, that is to maximize their profits. Thus, they're aiming to maximize the gap between total revenue and total cost. The question is, what is the output level that will maximize that gap? What is the output level that will maximize economic profit? So here's a total cost curve. We've seen this before. Let's assume that our firm is a price taker. That is to say, the price of the product that they're selling is fixed in the market, and they can increase their revenue by selling more of the product, but without the price changing. In that case, you'll recall from a previous video that it means that the revenue curve, the total revenue curve, which will start at 0, when you sell nothing you make no revenue, the total revenue curve will be linear, will be a straight line upwards. Now when we look at when we compare these two curves at each level of output, comparing total revenue and total cost, we can see at very low levels of output that the firm actually makes a loss. The total costs are greater than the total revenue at each of these levels of output. And we can see at the level of output of 6, the total revenue will just equal the total cost. So we'd say at this point the firm would be breaking even if it chose to produce 6 units of output. But obviously it can produce more than that, and as it produces more, we can see that the total revenue curve will be above the total cost curve. So at output at these levels, the firm is making profit. The question is, what level of output should the firm produce? All of these quantities produce profit, but which quantity produces the maximum profit? That's our question. Now, just looking at the graph, you can do an eyeball test and say, well, the gap between the total revenue and the total cost seems to be largest around here somewhere. But where exactly is the largest profit to be made? Let's go back to our table, and this data here is the data which I used to construct the curves which we just saw. We want to calculate the profit. So that will be the total revenue minus the total costs. We can see initially total revenue is 0, but the total costs are 500. We know it's so in that case we've got a negative profit. The firm's making a loss at the level of 0. As it produces more, however, we can see that that loss gets smaller as total revenue rises and total costs rise, but total revenue rises faster. So we can see that the firm eventually starts to make profit. At 6 units of output, they'll just make a tiny, tiny bit of profit. And thereafter, profits will increase until we get to 11 units of output. So the profit being generated at 11 units of output is $651. But at 12 units of output, the profit would be lower. So it's not always the case that if you just produce more, you'll make more profit. We can clearly see here that as the firm produces more, its profits, the profit at each level starts to decline. So there is some quantity that's not an infinite quantity where the firm would maximize its profits. Let's look at that on a graph. In fact, let's graph the profit that could be generated. So we know that the gap between total revenue and total costs is profit. So let's graph that gap. When we do that, we get this curve here. This is our total profit curve. And we can see that it's negative initially and becomes more negative. Then it starts to get smaller, becomes less and less negative. At 6, the profit is at the level 0. And from 6 onwards, profit starts to increase. The gap between revenue and costs starts to increase. So the profit starts to increase until we get to, here's the peak of the profit curve. This is the maximum profit at 11 units of output. The gap between total revenue and total costs is this profit here. Okay, now we should bear in mind that, are we talking here about the short run or the long run? Well, if we go back to the table, we can deduce that this firm, we're talking about the short run here for this firm. How do we know that? Because we know at the level of 0 output, we can see that total costs are 500. Now, why would total costs, why would there be a total cost of any amount if the firm was producing nothing? It must mean that the firm has fixed costs of 500, which are paid no matter how much output is produced. So when the firm has rent to pay and has interest payments on its loans to make, those are fixed, those fixed costs exist even if the firm produces nothing. So we know there are fixed costs in existence, and therefore if there's fixed costs in existence, we know we're talking about the short run. There's a distinction to be made between the fixed costs and the variable costs. Okay, so we know here we're talking about the short run. So far, so good. So the profit maximizing output is at 11 units. Is it possible for the firm to make a loss? Well, if we looked at the previous graph, you can clearly see there are certain levels of output where the firm would make a loss. Let's say we're talking about a price taker again. So we're going to have a linear total revenue curve. And let's say that for some reason or other, the market price falls. Now, if the market price falls, we know that the total revenue curve is going to fall as well. It's the it will still have an origin. It will still start at the origin point on the Cartesian plane at 0, but it will pivot downwards. So let's say that due to the fall in price, and therefore due to the fall in total revenue at every level of output, the firm now starts to make a loss at every level of output. Our question now is, even though the firm is making a loss at every level of output, should the firm shut down? And by shut down here, in economics, we mean produce nothing. It doesn't mean leave the market. It just means shut the doors and not offer anything for sale. So here's our graph. And we've said that the price has fallen to $150 each unit. And therefore, the total revenue curve has now shifted downwards. It's pivoted downwards so that it is now below the total cost curve. And what's this curve here? This is the total variable cost curve. All right. Should the firm produce output at all, or should it shut down in this scenario? Well, the way we can decide that is to compare the loss that is made if the firm produces nothing versus the smallest loss that it makes if it produces some level of output. So let's draw in there's our total profit curve. See, the total profit curve 0 is here. The total profit is negative from the start, and we can see it's all downhill from there. At 0 level of output, the loss generated, which is 500, the loss generated is less than at every other level of output. So we can say that although total revenue, here's our total revenue, although our total revenue covers some of the total variable cost, covers some of the total wage costs, right? So total revenue comes up to here. Total variable cost is a bit higher than that. So the total revenue covers some of the total variable costs, but not all of it. And it certainly covers none of the total fixed costs. In that case, we would say that the firm should shut down. Okay? Because at every level of output, the firm doesn't generate enough revenue to cover its whole wage bill or cover any of its fixed costs. It's not rational to close. It's not rational to stay open. It minimizes its losses by producing nothing. Now let's look at a scenario where the price didn't fall to $150, but instead fell to $270 instead. So the total revenue curve still pivots downwards, but not as much as before. Now we've got a slightly different situation. Let's calculate the profit generated. In this case, we can still see that the total revenue curve, the purple straight line, is still always below the total cost curve. So it makes a loss at every level of output. But in this case, as we'll see, that doesn't mean the firm should close down. Here is the total profit line generated. That is the gap between total cost and total revenue. And we can see it's always negative. It's always below 0. But if we compare the amount of profit, or the loss, generated when the firm produces 0 versus the smallest loss at some quantity greater than 0, in this case 10, this is the peak of the, in this case, loss curve, we can see that the loss is smaller, slightly smaller, if the firm produces 10 units of output versus if the firm produces nothing. So we can say from that alone, that information alone, that it's rational for the firm to stay open, not to close, and produce 10 units of output, despite the fact that it makes a loss. Because at every other level of output, including nothing, it makes a bigger loss. So it's rational to produce 10 units of output. We can see in this case that, the total revenue around this area here, these quantities here, the total revenue covers all of the total variable costs. See our total revenue curve from the point of 6 units of output onwards, is the total revenue is greater than the total variable cost. Okay? So the firm's revenue covers all of the total variable cost, and it covers some of the total fixed cost as well. Right? And the gap between total cost and total revenue is smallest at the point of 10 units of output. So we can see in this case, in this type of case, it's rational for the firm to produce 10 units of output, because at that point it minimizes its losses. And we can see this in some real-life scenarios. So sometimes you can find that a business will stay open despite the fact that it's making a loss. Why would it do that? Because if it closed down, the firm would have to pay or the entrepreneur would have to pay all of the fixed costs, which have to be paid no matter what, all of the fixed costs out of their own pocket. But if they stay open for business and produce, say, 10 units of output, the firm will pay for some of the fixed costs, and the entrepreneur will have to pay the rest out of their own pocket. So it's better to stay open in that case and let the business pay for some of the fixed costs rather than producing nothing and the entrepreneur having to pay all of the fixed costs out of their own pocket.